I think the most bearish thing that can happen for the stock market is when the Fed stops raising rates.
Jason Shapiro is back. He is the principal of JS Trading LLC, and we will be talking about his outlook. Jason was previously bullish, so let's see if he still is. Welcome back to the show, Jason.
Thanks for having me, Dave.
3 months ago, in April, you gave us some very important insights as to where the markets are going to go, and you've been correct so far. Now, you said that once everyone gives up on this idea of a recession, that's when markets will start actually turning south. Now, I'm not saying everyone has given up on this idea, but a few large entities have. Bank of America, for example, a couple weeks ago recently changed their outlook from a recession to soft landing, so no recession this year. They're pushing their recession outlook back, and they're not alone. Other Wall Street firms have followed suit. Citigroup, Goldman Sachs both raised their S&P 500 year-end outlook. The Federal Reserve previously, a few months ago, their own staff has projected a mild recession. I think they revised that. And so the question is whether or not this sentiment is starting to shift now. Is that what you're seeing?
I mean, it's definitely starting to shift. I don't know that it's completely shifted, but we're definitely have gone from where everybody was just assuring that there was going to be a recession in the second half of this year to them backing off on that. And really, all they're trying to do now is just kind of push it out. It seems like move the goalposts a few months down the road. But yeah, shifting, but not shifted, I would say.
Yeah, it seems that they have, and you're right. It's not like they're saying there's not going to be any sort of economic downturn ever, or at least not in the next 5 years. They're shifting the goalpost. That's not enough for you, though?
It's not a question of if it's enough for me, but I'm not getting short the stock market right here, if that's what you're asking. You know, I'm out of my longs. You know, I tend to go from extreme to neutral. So we've gone from where people were extremely bearish and I was getting long. We've now gone to what I see as neutral. So I am flat. So I don't have a trade in the stock market right now. I have some other things that are going on based on the sentiment and the positioning stuff that I look at, but there's no stock market kind of low hanging fruit trade here. So
can you tell us why you've exited some of your longs and gone neutral? Is it because of what we just described or something else?
I mean, my stuff is all based on my read on positioning in these various things, which a lot of times will follow what we've talked about. So in the stock market case, it certainly has followed that. You know, they were super short, as we spoke about at the end of last year, which was getting me long, and now they've kind of gone neutral, which gets me out. Yeah, it's just how my process works. It's not really a read on the macro thing, but it does sometimes correlate quite a bit to the macro psychology.
Some traders and investors look at valuations. Once the forward PE reaches a certain point, they start taking positions out. Is that something you do?
No, it's not something I even consider.
Valuations, there's a belief that valuations aren't a good indicator of price. I'm guessing that's something that you, a belief you hold or not?
I just don't think valuations are a good indicator of timing. So as a trader, I have to time things a little bit better than what valuations give you.
Is that something to do with your time horizon, in the sense that if you're a shorter term trader, valuations targets aren't really that important to you because you're not timing things for 5 years out, 7 years out?
I think it's a combination of it. Has something to do with that, and it has something to do with I don't think that anybody can forecast 5 to 7 years out. So it's kind of silly to me.
But would you agree with the assessment that if you were completely out of the market now, and you wanted to get back in now, the risk-reward profile is kind of low in the sense that things look expensive?
No, I wouldn't agree with that assessment. I don't know what expensive means. Expensive relative to what? To history? It's very easy to say things are expensive relative to history, but who cares? What we want to know is, are things expensive relative to the future? And I don't know how I just don't know how you determine that, because you don't know the future, and you certainly don't know the future any better than the entire market is discounting in already. So, I just don't see the edge there when it comes to trading or investing.
Okay. Can you share with us some of the technical indicators you're looking at that perhaps would suggest that the markets are, going either way?
So, like I say, I focus mostly on positioning. And the positioning data is in the stock market pretty neutral here.
Positioning and who's part of this positioning that you're looking at? Is it the retail, the institutional guys, the banks?
I look at the commitments of traders data for the futures markets, and that has a combination of three different sort of groups, and all three are pretty neutral right now. So to me, there's really no edge there. Now, the market is certain to go either up or down, right? It just doesn't give me an edge in being able to figure out where the risk reward is on that right now in the stock market. So
let's suppose you were to, at some point in the future, shift your stance to a net short position. What positioning data would need to be on the print for you to confirm that short position?
Well, it would need to show that speculators were getting very long and very bullish. The way I see the data now is neutral, because where they came from a place of very short early in the year, the market clearly has moved up quite a bit. So you're going to have your trend followers and your momentum traders getting out of those shorts and quite possibly being long. Whereas it feels to me, from what I read and what I listen to, that the fundamental people and the macro people have not gotten out of their shorts. They remain bearish. So therefore, you end up with these guys are long, these guys are short, and you end up with just sort of neutral positioning.
Did you look at the yields at all? The 10-year yield and perhaps even the short-term yields, 2-year movements in fixed income?
Yeah, I trade all that stuff.
Do you think yields are an indicator of equity movements at all?
At some point, I think there's some correlation there, sure.
Well, can you describe this correlation to us, Jason?
Well, I mean, clearly, higher yield. See, if you really want to talk about how I see the macro stuff here, and I kind of back into the macro stuff based on where I'm seeing position and psychology, but the big thing here to me is, and what I was saying, I think, at the end of last year. In fact, I was saying this way before then. I was way early on predicting when this could happen, but I think the most bearish thing that can happen for the stock market is when the Fed stops raising rates, right? And I say that because they've been raising rates, and every time they do, the yield curve goes inverted, which means that the long rates stay low, right? So when they stop doing that, because obviously people can make the assumption that, oh, the Fed's raising aggressively, so inflation should come down in the future and economic growth should come down in the future, so long end rates can stay low. So I feel like the opposite will happen when they stop raising rates. People can stop assuming that inflation is going to come down in the future and stop assuming that economic growth is going to come down in the future. And therefore, the yield curve will then go back to normal from being inverted. And then you have a problem, because then you have long rates going up, and long rates are really what control most of the economy. So once that happens, then I think you can get the things that people have been looking for, the recession coming and the stock market following it down and all that stuff. But I think there's probably going to be a period here where people see it as Goldilocks-y, right? The economic numbers are good. The inflation numbers are good. The Fed doesn't have to raise rates anymore, and therefore they can finally give up on their bearish stock market thoughts, and they can race into the market. And I think that's when everybody will get long, and that's when I'll be looking to short, which should be right at the right time, because then as they're all getting long and giving up on the recession thing, that's when long rates will go up, because the Fed's no longer raising rates, and that's what can then bring the stock market up. And that's kind of what we're in the middle of doing. You can see that the yield curve has been starting to steepen the last few months. It clearly, if it's going to do what I'm thinking, it has a long way to go. And you've seen that show up in the positioning as well. The big positioning for me in the last month to month and a half was the dollar. People had gotten very, very bearish dollar. So being long dollar looked like the trade to me. And clearly the dollar is going to go up as the yield curve steepens. And that's exactly what's been going on. So I think we're in the middle of all that right now. We have to get through this whole thing, and then maybe you can start thinking about going the other way on stuff. But we're like right in the juicy middle of that whole trade of dollar strength because of yield curve steepening, because of economy getting better, and that whole thing.
It does occur to me. I bring up the yields because there's been a very close correlation, like you mentioned, between the 10-year and the S&P this year. Usually, the long end of the curve could signal an economic recovery or boom if the yield goes up. That seems to be the case. So, if someone were to say to you, Jason, there is no recession, markets are already pricing in no recession. Things are only going to get better from here. And so it only makes sense to stay long and, forget shorting just altogether. Would you agree with that?
When I hear that, that is when I will be looking to short.
Okay.
We haven't heard that at all. What you just said, we haven't heard that from even the most bullish person. So
you're right.
I think that the market, again, I have no position in stocks.
Well, hold up. The most bullish person is Jerome Powell. He's been very vocal about the fact that everything's going to be all right for a while. He's always stuck to his soft landing thesis, which I give him, kudos for his conviction. But that, does that, he should have the most weight when you think about it. Do you care what he says?
I mean, he doesn't really make comments on the stock market or anything like that. He'll make economic comments, sure. And he has to say that. Obviously, what's he going to do? Jerome Powell gets up there and says everything's not going to be okay. Like, he'll freak everybody out, right? So I don't know that he can necessarily say that. But I'm talking about the participants in the market. I have not heard one person say what you just said a few minutes ago. Everything's great. Don't be short ever. When we start hearing that, I will be interested in shorting the stock market. But we haven't really heard that.
Yeah.
I think we're working our way towards it, but I still think we're still have a little bit to go on a positioning for sure, and on a psychology measure, we have a bit of a way to go there to get there.
Do you think there's going to come a point, maybe that point's already here, where the retail crowd is really going to FOMO into the markets and just drive up the margins or drive up the prices on the margins up, meaning we're going to get a final spike before some sort of correction or meltdown? Now, does that usually happen before correction occurs, that we have a big push from the latecomers?
Yeah, I don't know why it has to be a retail FOMOing. Why can't it be hedge funds FOMOing? They're just as short sure. They're just as short and bearish as retail is, right? Yeah, there's certainly been. I don't know how it's going to happen. I don't know how it's going to happen. This has been the mystery for me this whole part of this year, is what is going to get these people to bite the bullet and get long, right? What's going to get these fundamental macro hedge fund people to bite the bullet and just get long? What's going to get the retail people who have pulled quite a bit of money out of the stock market and put it into bonds and are underperforming because of that? What's going to get them to bite the bullet and get long? I just don't know what it is. And if it never comes, then I think the market's just going to keep going up. Even the most bullish people say what you just said, which is, okay, we'll get a final thing and then we'll crash. It's always, and then we'll crash. Well, why does the market have to crash? I don't understand. Why is it always something is going to happen and then we're going to crash? I don't really get that. I'll tell you, to me, the one possibility here that I see from my lens of the market going down a lot is, we've had a big call here by a lot of people that the S&P was going to go and test sort of the 41 to 4,200 level. And that once that gets tested, then we are going to move up to new highs going into the end of the year. Well, if that's how everybody really feels, then should it get to 41 or 4,200, they're going to buy the crap out of it. If they really think that if we're then going to go to year highs, right, they're going to buy the hell out of it. And if they do that and the market gets super long into the dip, then I think we'll have a big move down, because they certainly have refused at this point to get super long into the rip. So maybe they'll get, I don't know, once if the market goes down to those levels, we'll see if people actually step up and buy it. It's easy to say you're going to, and let's see if they actually do. But if we do that and you get a huge amount of buying at that level, and then I think the market can really have a big fall down, because I think it's driven by that positioning. So if that positioning does get super long into the dip, then I think we'll have a big drop. But we have to wait and see if that's going to happen.
Yeah, that's a very interesting perspective. Not a lot of people I talked to have commented on the possibility of the momentum not sustaining, because most people have told me once let's say the SPY, this could really apply to any asset, but let's take the SPY. Suppose it reaches new all-time highs. You typically would want to stay long on the momentum because that signals even higher highs. But you're saying there's a possibility. Okay, so my question to traders is always, when something breaks an all-time high, how do you know if that's a momentum play for you to get in, or that valuations are overstretched and it's time to stay out? How do you, like, what would you look at to make that determination?
I don't think you do know. I don't think you do know. If that's the terms you're thinking in, then I don't think you do know. To me, I always go with positioning. So if massive amounts of people are buying into that new all-time high, then I'm probably getting out. If they're selling into that all-time high, then I'm probably staying in.
It wouldn't bother you as a trader that maybe if you do that, you're missing out on some of the upside until it tops?
No, I trade a process. The process has worked for me. The process gives me the return stream that I'm looking for. I don't have regrets about trades, and listen, sometimes even within my process, I mess up. But it is what it is. You know what I mean? You're not going to get every tick in every market. You play your game and you get what your game gives you. That's really all you can do.
Okay. We talked about stocks quite a bit. Can we maybe move on to some of the other asset classes that you also look at? So you briefly mentioned the dollar. Now, the DXY is under a lot of different macro forces. On the one hand, you've got the Fed potentially stopping raising rates while the rest of the central banks aren't really there yet. What are the forces that you're looking at that could drive the dollar?
Again, same force.
Okay.
It all starts with positioning for me. So we came in.
Huge rally since the beginning of.
We came in at the middle of July where the dollar started to go to lows, and you saw a massive amount of dollar shorting going on. People were coming out of the woodwork, being bearish dollar, shorting dollar, long in euro, long British pound. Those are the two big ones, and also arguably the Canadian dollar. And that's when I was looking to be long dollar. We are now seeing the dollar go up from there quite a bit. And we're starting to see the unwind of the short, but not to the extent that it needs to get for me to believe it stopped. So you can then back into everything else. If the dollar is going to continue up, that probably means, again, yields are going to continue up, in particular on the long end, right? You're going to continue to get this steepening. And again, what's going to cause a steepening, in theory, on a macro view, is views that the economy is stronger. So usually I would say, okay, so dollars going up, yields are going higher, that's bearish stocks. I'm just not sure that that's bearish stocks, because if it means that the economy is getting stronger and people are coming from a place where the economy was going to get weaker, that might actually be bullish stocks. I don't know.
Now, again, nobody knows.
I think stocks are not necessarily the best play, but I think that the best play is the yield curve, and still to this point, the dollar, which then turns into you want to be short things like gold and silver and all that, because a higher yield curve and a stronger dollar is not going to be good for those things. And my favorite short, quite frankly, in here is energy, which I think is the thing that people are most bullish here is energy. I hear the energy call now multiple times every single day. So that's really what I would be looking to do here, is be short energy, short metals, long the yield curve, long the US dollar.
So positioning on, just to clarify, positioning on gold, positioning on oil, crude oil, very, very bullish right now is what you're seeing?
Positioning in particular on heating oil shows people are extremely long, extremely long. That's the most offsides positioning that there is out there right now, from the stuff that I look at anyway.
Okay. Just to clarify your procedure. So when you see something that's really, really long, do you start shorting right away, or do you wait for that momentum to kind of wane it before you see it as an indicator to flip?
I wait for the market to confirm what I'm thinking first. I'm not just going to do it just because I have one reading on the crowded stuff and okay, people are super long here. I'm not just going to get in the way of that, because you can get run over doing that, right? I wait for sort of the market to confirm that first. And that's really based on how it's reacting to news. So if I'm looking to get short crude oil, then I'm looking for something like a bullish inventory report to come out. They're looking for a draw of 1 million barrels. It actually draws 10 million barrels. That should be bullish crude oil, and crude oil not to go up on that news. So there's the market confirming like it's no longer going up on bullish news. And the reason for that, in my view, is because everybody's already long. So that's when I'll start to short.
Okay. You're a lot of people would think that your positioning thesis makes logical sense. One thing we haven't talked about in terms of your process is how you look at historical price patterns, whether or not that's relevant to you at all. So let's take crude oil, for example. All right, $82 for WTI right now per barrel. Still quite a bit away from its highs from last year. Some technical traders might look at this and say, well, look, the price is still, $40 off its highs. If you want to see momentum, that really is your kind of target to reach. How would you respond to people that look at targets from a historical price perspective?
They're doing something that I don't either do or have the ability to do. So how would I respond to them? I would wish them a lot of luck in what they're doing and hope that it works for them. I have no idea of forecasting the target. I'm not taking measured technical levels and being, okay, this thing was here, so therefore it should go up another $30. I don't do that. I don't have any ability to tell you where crude oil, for example, should be on a price level based on global supply and demand statistics. I could never do that. I have no edge in doing that. I certainly hope that there's someone out there that can tell me global crude oil supply and demand statistics better than I could, because I just don't see the value in that, in forecasting the future of that, because I don't know how. There's so many moving parts there. I don't know how you could forecast that. So I try not to play in places where I can't develop an edge. So I'm not really doing price target. I'm doing, like I say, they get too long here, market stops going up on good news, I'm going to get short. That's all I do. It's just odds. I'm just trying to play odds.
Fair enough. Now,
unfortunately, I'm not smart enough to forecast the future. I wish I were.
I think a lot of people who listen to this would think you're very humble, because your track record's been pretty good so far.
Which has nothing to do with me forecasting the future. Honestly, it has everything to do with me just playing an odds game. That's all it is. That's all this is. So I'm just playing a game of odds. I lose a lot of trades, and I make on some trades. But I always say I make a lot more on the ones I'm right on than I am than the ones I'm wrong on. And over time, that works for me. But it's all just odds. It's just like playing blackjack, right?
There are some people that have resigned themselves to the fact, whether it be through academic research and theory or just experience, that they can't beat the markets. They say, Jason, I don't know how to forecast the future. I don't know how to repositioning like someone like Jason. I'm just going to buy the index and hold, because I've given up on the trading and the stock picking game. Even if it's just timing in and out, I'm just going to buy, hold, go to bed, wake up in 20 years and collect my returns. Why don't you do that?
Because I'm stupid. If I had taken all the money that I have managed over the years, I'm sure of this, okay? And I dollar cost averaged that entire time. Now, I don't know that anybody would have accepted the drawdowns as I was for doing this, right? In 2008, there was obviously a huge drawdown, for example, right? But if I had just dollar cost averaged all the money that I've managed over the years into certainly a NASDAQ ETF, the QQQs, I'm sure I would have made a ton more money than I have made. Right. But to take the other argument is that that's not what I as a money manager am hired to do. My clients specifically give me money because I have a return stream that has had positive returns. Yes, but it also has zero to negative correlation to just about every other return stream. So when you are building a portfolio, you need to find things that have negative correlation, and it's hard to find that, right? So that's what I do as a money manager, and that's why my clients hire me, right? So there is value to what I do, despite the fact that it might have underperformed on a return basis, the dollar cost averaging thing, because if you put me in with that dollar cost averaging thing, it will increase your risk adjusted returns because of the non-correlation, and it will push out the efficient frontier. So that's what my business is. But I think that for most people, what that person that you just quoted said is 100% right.
Do you ever hedge your position? So let's take early in the year, for example, when you were still very much long the SPY. Did you ever at any point buy put options on the Spider, or did you have assets that you found that could be inversely correlated and have positions in that?
I occasionally do that. I did not do that this year. I don't buy options, first of all. I never trade options, nor would I suggest anybody else ever trade options, but that's just me. But I will get positions in other things that will help to hedge and have a portfolio of sort of, relative positions.
Right, and that depends, I guess, on positioning strength. If your conviction is really strong, then you don't really feel like you need a hedge, right? Is that your process?
If the process says to be here, that's where I am. There's maybe one or two times a year where I might hedge something. If I get too one-sided and all my positions are all one-sided, then I will look to be hedging them. But hedging could just mean reducing.
Jack Schwager interviewed you for his book Unknown Market Wizards a couple of years ago. I think it came out 2020. The book. Now, it hasn't been that long ago since the book came out, but if you were to redo that interview again, would you have told him anything different about your process? Meaning, has your trading philosophy changed in the last 3 years?
Nope. I do the same thing now that I did then that I did 20 years ago. I really run the same process.
Because I do know because I do know in the book you describe your very early career when you did the exact opposite of what you're doing now. So I'm just wondering if that process has evolved even, on a 5-year shorter term time frame.
No, I've been doing pretty much the same thing now for about 22 years.
Okay.
What I did before, where it says in the book, I did the opposite of what I did, but I did what really everybody else does. I tried to look at the macro stuff and tried to forecast the macro and, that whole thing. And what I found was it didn't get me anywhere. So I changed.
Final question. So you mentioned a few faux pas that you personally would not do or undertake. For example, you just said, don't trade options. Don't recommend people do. All right. So I'm a new trader. I don't have much experience. I just read the book. I just read Jason Shapiro's bio or chapter in Unknown Market Wizards. I like his process. How should I learn this process?
Well, we specifically set up a site for people that came to that conclusion after they read Jack Schwager's book. I was getting a lot of people asking me that very question. So we set up this crowdedmarketreport.com that they can come and join, and they can learn that not just this process, but they can also learn a lot about the psychology of trading and the importance of risk management and how predicting the future is not the way towards successful trading. Using risk management and using discipline is the way towards successful trading. And that's right on there. There's also, I do YouTube videos every week, which is totally free on Crowded Market Report on YouTube. That they can check that out.
Okay. And I think you have a Discord as well. You mentioned other ways people can join your community.
Well, as part of our service on Crowded Market Report, it includes a Discord page, yes, that everybody goes on. And there's a newsletter. There's a Discord page that I'm on and all the people are on, and has really become a great thing because there's a few hundred people on there and all of them have different views and different ideas, and they all talk and we all talk about this. And it's really to be focused on the ideas of becoming a better trader, not I do put my trades on there and I do put my process on there, but I encourage people to not join because they want to mimic Jason Shapiro's trades. Okay. It's just a bad idea. And for so many reasons, right? They should join there if they want to learn how to become a better trader for themselves, not because they want to mimic Jason Shapiro, because Jason Shapiro was in Market Wizards and all that kind of crap. They should come on there because they want to learn how to get in their mind how to become a better trader.
Well, you've got a large community of traders that you work with. So the newcomers on your platform, in your community, have you noticed a few common mistakes that the newcomers have made?
I think the most common mistake is they come on there and they try to mimic my trades, which you can do. Okay. All my trades are on there. I talk about these are the trades that I'm going to make the coming week under this circumstance. And then we talk about it on the Discord page. Hey, this circumstance is happening. I'm putting this trade on. You can do that if that's what you want to do. But I think that's the biggest mistake that people make on my side for a number of reasons. But
well, I mean, they look at your track record and they go, well, this year Jason's been all right.
I get it. Okay. I get it. But so when you're going to come on and the first 3 trades that I make are going to be wrong. Okay. And you're going to lose money and you're going to say, oh, this guy sucks. It's a scam. And then you're not going to follow me on the next trade. And then the next trade is going to be the home run. And now we're going to be 4 trades into it and you're going to be down money and I'm going to be up money. And, that's just one of the many reasons why why you shouldn't do that. I have over a 20-year history of trading this process. I know it. I developed it. I trust it, right? So I'm not going to run away because there's 3 bad trades. You don't have that history, so you are going to run away when there's 3 bad trades, and then you're going to miss the good trade, right? That's one of the many reasons. The other reason is my return stream, like I said, is developed to be negatively correlated to a lot of other things, and that's why people put me in their portfolio. That's my business. That might not necessarily be your goal here, right? And I can get into a whole bunch of reasons, but one more reason is I'm going to be dead one day. Then what are you going to do, right? Why not learn how to trade? Like I like to hope that I'm helping people learn how to fish, right? I'm not giving them fish. I am helping them learn how to fish so that whether I'm here or not, you can now be a successful trader without, and I tell these guys, your goal should not be to get my return. Your goal should be to be better than me. You have the advantage of, sure, you can learn stuff that I'm teaching you. You can also learn stuff that other people out there can teach you. And you can take all that stuff and amalgamate it. You can be better than I ever could. Why not go for that?
Yeah. Okay. Makes sense. All right. So it's for a community of people who want to learn how to trade. Because there are some people out there who look at like a Warren Buffett index, for example. They actually look at Berkshire Hathaway buys and sells, and they just mimic Warren Buffett because he's been legendary. Why not follow somebody with a good track record? I guess that's one. Why
not just buy Berkshire Hathaway? You know what I mean? Like if that's what
I guess they.
Do,
I guess they take.
Why not buy Berkshire Hathaway then? And Berkshire Hathaway, I think, is on all-time highs. So that's not a horrible idea. I don't know that their returns over the last 15, 20 years, I'm speaking out of turn because I don't know, but I don't know that they've necessarily outperformed the market, but certainly they haven't done too poorly. They're on all-time highs right here. So,
Fair enough. Yeah.
I think that's probably right. Warren Buffett, I would have to think, is probably going to have a shot, although he's 150 years old at this point, but is probably going to have a shot at being a better stock picker than you are, I would think. So why not just buy Berkshire Hathaway? It's not horrible.
All right. Well, learn how to trade with Jason. Follow his links.